Now, our guest for this week's show is developer and real estate investment expert Bill Shopoff. Now, Bill has more than 40 years of real estate and investment experience. His expertise includes the acquisition, development, and sale of new and redeveloped residential and commercial properties throughout the United States, as well as partnership structure, debt placement, venture capital, and investment underwriting. And so, guys, I'm excited to get onto the show with Bill. But before we do, I just have a few quick housekeeping items I'd like to run through. First and foremost, I get a great deal of emails, asking what we're up to here at Sunrise Capital Investors. I used to give updates at the beginning of the show, and I just haven't really done that for quite some time. And, just to give you a quick update, as always, we're always busy doing what we do. And that's, seeking out investment opportunities that offer the best risk-adjusted returns, which was the catalyst for our most recent fund launch. If you guys haven't heard of it, we just recently launched the SCI Phoenix Build to Rent Fund 4. And if you don't know about Build to Rent, then you absolutely need to get into know. Per Green Street data, Build to Rent residential real estate has taken the lead ahead of every other asset class to provide the best risk-adjusted returns, and even better than mobile home parks, which has held the lead spot for a number of years. And you guys know that I love mobile home parks. And if you'd like to learn more about Build to Rent or learn more about partnering with us in this exciting opportunity, you can visit kevinbupp.com/BTR fund. Again, that's kevinbupp.com/BTR fund. And you'll get access to our recent Build to Rent webinar and also supporting offering memorandum. Additionally, once you fill out this form, you will not only have access to the offering, but you're also going to get an invite to our live interactive weekly Build to Rent webinar series. We just started this a few weeks back, and these webinars, they're live and they allow you the opportunity to get your questions answered. Again, they're interactive. We want people to participate, and they've been a lot of fun. Again, we started these roughly a month ago and look forward to continuing these for many, many months to come. And so if you want to come and learn what all the hype is about in the Build to Rent space, then I definitely suggest you watch the webinar, but also come join our webinar series that we're doing each and every week. Each one of these is roughly 30 to 40 minutes long. And again, we allow you to ask questions live and get them answered. Last thing here before we get on to the show with Bill, I recently launched my best-selling book. It's called The Cash Flow Investor, How to Create Financial Freedom Investing in Commercial Real Estate. Some of you might already know that I launched it. Some of you might not. It happened a couple months ago. And ultimately, this book it's for sale on Amazon for $20, but for a limited time, I'm going to be offering the book for free to my tribe of cash flow investors. And so if you'd like to grab a free copy of that book, go to kevinbupp.com/free book. Again, that's kevinbupp.com/free book. And now with that, let's get on to the show. Ben, how you doing today?
Great. Good to see you.
Yeah, excited for you to be here. And guys, as I had mentioned there in the introduction, we're also going to be joined here in, sometime in the next few minutes, maybe 5-10 minutes, by Bill Shopoff as well with Shopoff Realty. And, just to give you a quick overview, again, gave you a little bit in the introduction there, but, Bill's been at this game for over 4 decades, and he's acquired, more than 1,000 properties, and that's spanning multifamily, land entitlements, retail, office, mixed use, and, tens of millions of feet of just commercial real estate in general. And so, he's literally done a little bit of everything, and he's typically skating to where the puck is going, right? And so they're a value add investment firm through and through, and so he's just got a litany of experience and just many different facets of real estate and asset types. And so again, he's going to be joining us here in roughly 10 minutes. But just to give you some context of how this all came together, I did have Bill on the show way back in like 2016. It's like a million years ago, right? Especially in podcast terms, right? That's a long time. And so, but Ben reached out to me. Ben reached out to me a few months back. Again, just really given the turbulent might not be the right word, but I like to say turbulent and somewhat, unique is probably the better word, unique economic times that we're finding ourselves in. And he suggested that we get him and Bill here on the show and just really get their perspectives as to, where they think we're at in the cycle, what strategic changes they're making in their business as we go through these unique times. And so we're here now. And guys, just to give you the additional context, we're recording this on August 5th. And so we'll probably speak to, things such as rates and the 10-year and things of that nature. And so just to kind of tie it all together, tie the pieces together, again, it's going to be August 5th that we're recording this, and it's probably going to come out a few weeks shortly thereafter that. But with that, Ben, again, happy to have you here. Excited to have you here. And for those that aren't familiar with you and Integris Investments, why don't you take a few minutes, tell us a little more about yourself, your background, and what it is you do there at Integris.
Yeah, I'm the director of the private client group for Integris. And Integris is really kind of the customer facing side to Shopoff Realty Investments as part of the Shopoff Realty Investments family of companies. And a lot of what is done at Shopoff was with a select group of people, friends and family, long-term investors, in things that are just not out in the public eye. So, a lot of times people are surprised. They're like, wow, $2 billion worth of transaction volume, 1,000 full cycle assets, 30 years in the business. How have we never heard of this? Well, people in our core market or people in Irvine near some of our projects might know the name, but nationwide, a lot of this was behind the scenes. So if you weren't, an active investor or part of that friends and family group that has grown over the years, you really didn't know, who we are. I think we're the best kept secret in the real estate business. So with the Jobs Act, that allowed for a different type of offering that can be in the public eye, and afforded us the opportunity to share a lot more of what we do. So we derived this marketing channel, Integris Real Estate Investments, again, part of the Shopoff family of companies, that, those things that we do that we can have out in the public eye that can now be done under the Integris name. We can share a lot more about what we do. So, same group of guys, still Bill Shopoff, same management team. Effectively, everything is the same. It's just this is more, public facing, and
Got it.
not kind of done behind closed doors.
Yep, yep. Fantastic. And so, I spent some time on the Integris website and maybe speak to some of the, again, I mentioned that, the shop off just family of companies really has had their hands in many different types of projects over the years. And again, really, just speak to Wayne Gretzky, they always skate to where the puck is going. And so, saw some of the current offerings on the Integris website there. Maybe speak to those. I just give folks a sense of, again, what it is that you guys are actively participating in today.
Yeah, and it's a great example too. And it doesn't always work out exactly this way, but the two offerings that we have currently could not be more polar opposite. As you probably saw, we have a qualified opportunity zone fund in which we are building a hotel and casino on the Las Vegas Strip, which in and of itself, you know, I don't know of how many prior instances there have been where the average investor can come in, any accredited investor can come in and participate on a project on the Las Vegas Strip. I, I'm maybe there was one. I haven't done the full research on that, but I can't think of one. So really a unique opportunity, and obviously the QOZ benefits are amazing themselves. And we're seeing a lot of people that traditionally did 1031s or DSTs that are all of a sudden slowly but surely, learning about QOZs, which are relatively new. There's a lot of
Sure.
CPAs, a lot of attorneys that, just aren't 100% up to speed because they've been fairly new. But just, amazing programs. And then on the polar opposite side, we have a secured credit fund, which is a 12% rate. It's a 24-month term. Which is just a phenomenal number in this environment, and uh, that's really kind of what makes it a win-win. Is there's always opportunity in every environment, and usually when there's chaos and blood in the streets, there's the best opportunity. But people are the most hesitant, to invest. It's always
Hmm.
counterintuitive. But if nothing else, for folks, to just hedge now and say, you know what, I've deployed enough in multifamily, or I've deployed enough in office, or I've deployed enough here, and not that there's not opportunity, but I'm not seeing the opportunity I want to take advantage of yet. There's this program. It's like, hey, if you could make 12% for the next 24 months, all of a sudden it's not dead money. And you have to be conscious of it because inflation is what, eight and change, nine. I think the
Hmm.
last number I saw was 9.1.
Yes.
So it's kind of funny that in this day and age, we're talking about 12% being a little better than idle cash. But as far as, keeping ahead of inflation, 12% really isn't that far, ahead of inflation, but it's a great place to, either tread water, have a competitive return. And then the flip side is, hey, 12%, that's a solid number. What's the basis of this program? And at the end of the day, real estate firms like ours have needs for short-term
Hmm.
capital. That's just the normal course of doing business. It's nothing different than what we've done for 30 years. There's, different portions of the capital stack where it's bridge debt, mezz debt, operating income. And, sure, we can go out to traditional lending institutions, and they just don't like to loan short-term money. That's just not what banks and lending institutions
Mhm.
want. Long-term, loans that they can put on the books as part of their portfolio. So short-term money is very expensive. Rates have crept up, and by the time you take the interest rate plus the points plus the fees plus whatever they want to tack on there, you end up with a number approaching 12%. And years ago, Bill Shopoff in his wisdom said, "Hey, why are we paying these institutions, these ridiculous rates? Our existing clients would probably like to make, a return like
Yeah.
that." So we kind of polled our existing base, and they said, "Sure, absolutely, we'd love that." So that capital was raised very quickly, and it's something we'll do from time to time. Not necessarily on a regular cycle, not an offering that's always available, and it's a very small offering at $8.5 million, which to some folks sounds like a lot of money, but in the grand scheme of things, when you're doing $500 million transactions, 8.5 million is not a lot of money.
Sure.
Um, so yeah, that gives you kind of the diversity, and I think it sets the tone real well for the breadth of expertise and experience that we have as a firm. And any real estate operator who's going to be around over time, is going to evolve. You may come in doing, one asset class or one specialty, you master that. And I don't want to say exploit, that's probably not the best word, but you extract maximum value out of your time and experience with that asset class. And just as Sunrise has, I mean, you've had a growth, and you've evolved from where you've started years ago. And you learn about new asset classes. You learn where the market is telling you smart money is going.
Hmm.
So we see experienced operators such as yourselves, expanding their horizons and not being a one trick pony. Because there's plenty of those out in the marketplace as well, folks that say, "Hey, we do multifamily and do only multifamily, and we're going to do multifamily whether it's a good time to do multifamily or not, because that's
Right.
just what the firm does."
Yeah, no, I agree with you there. And talk to me about. I would love to get your perspective, and we'll also ultimately get Bill's perspective as well. But just what are you seeing, at least with Integris, as far as investor sentiment? Has it slowed down a little bit? Has it grown? I mean, just we're all over the place. The Fed's doing their best job. They're using their only lever they have to try to tamper inflation. And we've had a number of different Fed rate hikes over the last year, and ultimately that's going to continue on at least a few more times. And but the 10 years been all over the place. It was up. I think the peak was like in maybe middle of June or something like that. It was like 350. Now it's back down as of today to like, I don't know, 280 ish or something like that. I mean, it's just been all over the map. And so, a lot of investors some have tended to get bearish, and, some have just, they haven't slowed down. They just been, chugging moving forward. And so what are you seeing as far as your investors that are putting the capital into these different investments? What has their sentiment changed at all, or what's happening there?
It has, and really the sentiment I'm seeing change is how much people believe what they read in the news, which is a good thing. Because when things are going well, and it's funny going back to when we started our conversation about doing this podcast. I was looking through my notes here, and I think it was the end of March or literally the first week of April that we started having this conversation. And at that time, everything was still great. The world was rosy, and you could do no wrong, buy any piece of real estate, and you were going to double your money in 3 days. Sure, it's to an extreme, but that was the sentiment out there. And obviously the press cycles were perpetuating that sentiment. And the conversation you and I had was, we're boots on the ground. We live and breathe this every day, and we were starting to see the chinks in the armor, and things were not nearly as rosy as what they were in the news cycles. And we had that whole conversation. I think we killed half an hour on the phone just talking about how a lot of investors, unfortunately, they are 6 months behind what's happening in the real world,
Hmm.
because the press is probably at least 4 or 5 months behind what's happening in the real world. And I think that's really where the shock comes in, is not that the markets are changing and transitioning, because that's a natural evolution. We can go back. Nothing happening now mathematically hasn't happened previously. So it's not like there's not
Agreed.
a playbook for it. The market goes in cycles. But where people really get whipsawed and what does change the sentiment is when they see the headlines on all the websites and newspapers go from, everything is up, 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 to all of a sudden, home prices are going to crater and this is going to happen and that's going to happen. And it literally seems that news cycle switches overnight. So it's understandable that these investors are one, confused, and then fearful, because they're like, wait, it's not the fact that there was a change. It was yesterday you told me everything was great. And now today you're telling me every economist thinks there's going to be a 25% reduction in home prices, tomorrow. So I think that's what makes it difficult for people to, educate themselves, decide how to make prudent investment choices, decide on asset classes. And, as far as sentiment, yeah, I think people are more, befuddled and confused on where they can get good information. And that's why I'm happy to see, podcasts, such as yours, where, you're trying to bring timely information, to your listeners, factual information, a real good assessment of, boots on the ground. But no, I think people are reconsidering or recalculating, just as we are as a firm. But like we said before, some of the most gloomy economic times present the most opportunity. So all in all, it's those who can, make a prudent move when others potentially are a little fearful. But I think the sentiment's cautious, but I think people are still open to great ideas.
No, agreed with all that. And I appreciate you sharing. And as we see here, the man, the myth, the legend has entered the room. Bill, pleasure to see you again. It's been
Good to
many,
see
many
you. How are
years.
you?
Doing great and excited to have you here. Ben and I, we got started here and just kind of setting the foundation, but definitely looking forward to have you join here. And just really more than anything else, again, given these unique economic times we find ourselves in, might not be so unique to you. I mean, you've been at this now for 4+ decades, right? You've been through many different evolutions of the cycle, or of a cycle. And me, this is my second, I guess you could say, cycle, and so I'm still pretty much a baby when it comes to that, right? But really, again, just excited to gather your perspective, and just really forecast of what's now, what's coming. How are you guys adapting strategically to weather any storm that might come our way? And so, I guess with that, Bill, what I'd love for you to do is, for those listeners that are tuned in here that aren't familiar with Bill Shopoff or Shopoff Realty, take a few moments and just give us a little bit of a background of yourself, your expertise, and then we'll roll into discussion.
Sure. I'm Bill Shopoff, and I'm president and CEO of Shopoff Realty Investments, as well as Integris Real Estate, which is our sister company. I've been doing real estate for, I think, 43, 44 years, something like that. I'm kind of losing count, maybe because
I was going to say, I'm assuming you lose count at that point in time.
Maybe because I don't want to count anymore.
I forget my birthday already when it comes around every year, so I can imagine that you lose
it's
count
like,
of how many decades, right?
It's a bit like when I tell people how long I've been scuba diving, and my wife says, you can't tell people that anymore, because you're diving with these dive masters who are 20 something, and you've been diving more than twice as long as they've been alive. So I've been doing this for over 4 decades, as you said. I started this company 30 years ago with some partners down in Austin, Texas in 1992. Moved the company. I kind of went counter the flow. I moved the company about 21, 22 years ago to Southern California. We had some investments out here that I thought needed some attention. I kind of thought I could do it part-time and commute back and forth. And after about 3 years of commuting, I realized that, the work I was doing was really required more attention and more time. And I had a young family, and convinced my family to move to Southern California. And I candidly have had no regrets. I could give everybody the litany of things that are wrong with this place, but I would also tell you all the reasons why they're wrong, is why it's been great for us as investors.
Yeah. No.
And I think you got to go where you like to be, number one, and then you got to go where, there's opportunity, and we're in a supply constrained market, and values are good. So it's been an interesting ride for us. But our firm has been focused on value add and opportunistic investing for that entire time. there's been moments where we focus on distress when distress is happening, but we don't just do distress, because if we just did distress, we'd only get to do that sporadically.
Mm-hmm.
And in fact, probably the one time when I started the company was the time where there was a good long run of distress from 92 into the late 90s, kind of as the federal government was taking over savings and loans and
Mm-hmm.
had pools of assets to sell, and that was a great time for us. We did very, very well, but mainly what we did was we learned a lot about a lot of different real estate in a lot of different markets. And as a young investor, I was buying. I bought in 25 different states, so several markets in multiple states. I had to learn how to make quick decisions about values in places I didn't know much about, because there was a bucket of assets we wanted, and there might be an asset in a town I've never been to, never even heard of. In fact, the first time I came to California to look at assets, I'd only been to the coast of California. I didn't know about the vast inland stretch of California, other than maybe driving through it to get to the coast.
Yeah.
And I can remember I booked a flight and I flew into Los Angeles and got a hotel room that night. And the next morning I drove out to go look at the assets, and I realized that I passed two other airports that I could have flown to and gotten closer to the assets I was driving
That's
to.
funny.
It was like, yeah, the internet wasn't quite as prevalent then, like barely. And I was still using a map book to find my way around. But I found my way. We bought that pool. We did quite well on it. I remember one asset in it we bought we allocated 250 grand to one parcel that we sold for 4 million. So it's a good day.
That's a good deal. Yeah.
So you learn to adapt to the times. That was an interesting time. But we've seen opportunity to put our capital to work, throughout good markets and bad markets. And I think if we're cautious about it, we've been successful more times than we've not.
Okay.
The firm's done. Ben probably knows the number precisely, but I think it's about 1,035 full cycle opportunities. Maybe it's 1,037 today. Full cycle is something yesterday, so it's going to change. But full cycle means we executed a business plan, and then we sold an asset. And so we've done that over 1,000 times in 30 years. And I think there's very few firms, unless you go very, very large firms, there's very few firms our size, that have lasted, for 30 years, and then have been so prolific in the number of transactions. And in those number of transactions, we've been profitable on about 95% of them, something give or take. Some people take pride that they've never lost any money in the deal. And I say, I can also solve that. Don't sell losers.
Yeah,
and
right.
You never lose money.
And plus, I think the odds are not in your favor when you've done 1,000+ transactions, right? I mean, inevitably, there's going to be some dogs in the batch. It just happens.
Yeah, and we're striving for outsized returns, and so as one of my partners said, because we had several deals that had done very well, we had one smaller deal that did not very well, and it was in a different department of the same firm. And the one group said, well, why don't you ding his promote to pay for our deal? And the guy said, look, we hired Bill Shopoff to be our Barry Bonds. We pay him for home runs and we don't ding him for strikeouts.
I love it.
And that was one of my institutional partners. And I was like, look, we're not always trying for home runs, by the way. We're pretty happy to make singles and doubles. And sometimes you just want to stand in the batter's box for a long time and wait for the fat pitch. And I actually love Warren Buffett's analogy of baseball. He said the great thing about investing is there are no called strikes in baseball. So you can stand in the batter's box as long as you want until you see the pitch that you want. And then you take your swing. And so I tend to want to swing like the All-Star game for home run derby pitching. I want to swing when people are throwing me things that I can hit.
Yep.
And so that's kind of been our status, or our desire over the last, I don't know, 5 or 6, 10 years. Find things that others can't figure out how to do, and things that we will be paid very well when we do them successfully.
Getting paid to solve problems, right? I mean, I think that's what it's all about. That's what we're speaking to here. And you guys become experts at identifying, not just solving, but identifying what the real problem is, and actually coming up with a solution that is, either it's better, or it was never even seen by another party. And
look, I'm not going to pick on any particular, first, because I think, look, there's a lot of smart people doing what they do, and they just do something different than me. It happens to have been a great run that if you were buying, and by the way, I don't think it's completely over with. If you're buying net lease retail because of cap rate compression that's gone on for quite a while, that's basically followed the bull market in the bond, because those tend to track a bit, because the net lease business is heavily influenced by the price of debt that you can get, and as price of debt continued to go down, it made it very attractive. I candidly don't think we're done with interest rate contraction. In fact, I made a statement last week that I thought we'd be back at a 2% treasury within 6 to 12 months. I said that last week at a conference. A couple of people called me out on it, thought I was overly aggressive. And one of the guys sent me on Tuesday, Bank of America's forecast was in the next 6 to 12 months, we will be at a 2% 10-year. I said, well, I guess Bank of America heard what I had to say, had to get their charts in line with what I had to say. Yeah. I'm clearly kidding.
I agree with you. We've had the same internal discussions within our company, and just any deals that we're potentially looking to recapitalize, we're just let's hold off because there's the Feds, they're pulling their one lever that they can and trying to do their best to slow this inflation freight train down, but that's all they have at that point in time. And after that, in order to get the buyer sentiment, consumer sentiment back up again, get the spirits lifted, I mean, what's that lever? It just has to go in reverse, right?
I think, yeah, if you look at consumer sentiment, which is at the University of Michigan study is at an all-time low since 1952. So that means people aren't going to spend the money, even though they've got their savings accounts are more robust than they've been. They look at the news. We have a war. We have inflation. Stock market's taken a pretty big correction, and we're still dealing with COVID and the restrictions of COVID, political uncertainty. All of those things lead people to say, "Oh my goodness, I don't know what to do." And what I'm going to do is not going to go spend money on large capital. And I think that, I'm not a macroeconomist, and so I'm going to try to stay in my lane. Although I study with a lot of them, but I don't try to be one. I just listen to what they have to say and try to understand the what they're looking at to draw their conclusions. And I spend a lot of time on it. But I also don't try to invest based on macro cycles. I try to invest on, what I believe is inherent supply demand in the particular product and location that I'm looking for. And I'm also not trying to buy the lows and sell the highs. It's great if you could do it. Very few people are successful at it. There's a couple of people with great track records for short times. There's very few people with great track records for long times. And so if you want to get in and take a quick hit, and look, I've done it, in the market. I'm not a stock market player, but after the great financial crisis, it was like you might as well go into the market at some point, because if the world's going to go to zero, like, my money's not going to matter anyway. So I might as well take a bet.
Unique perspective. Yeah.
I don't mean to be that, pragmatic about it, but it was like, I believe that there's intrinsic value here. I got in, I got out way too early. I doubled my money, but I was in and out early and, missed a huge run up past that. But, I was in other things. I tell people every time I've sold something, I can always go back and look. And I was up in Hollywood the other day, and from my hotel room I could see a building I bought when I was young in this company, and we bought that building for like 2.7 or 8 million. I think we sold it 2 years later for 5.4 million, and we thought we were geniuses. The building was cash flowing massively. We should have never sold it. The market's completely changed in Hollywood. I mean, it was still, drug addicts and prostitutes on the street when we bought it and sold it. Today Hollywood's happening, and it's a pretty happening place. And the last time this building traded, it segregated into two pieces. One, so the building itself sold for 30 million, and I think the parking lot sold for 10 or 15 million.
Wow.
So, but I tell people, I said, like, it's not like that money was sitting. I had an unlimited bucket and I could hold it. I sold it. We reinvested the capital into other things that we thought could do better for us. I think they've done rather well for us. And so every time I've sold something, I can always go back into that. Oh God, I should have held it, and maybe I should have. But every time I sold an asset, I've either reinvested it or used it, to pay employees or to eat on, because I actually have to, feed my family sometimes.
Sure.
So it's always, the money's never like, it's not like there's a pot of gold at the end of the rainbow that I just keep adding to. I mean, we do, but the money's largely been recycled and put back to work in things that we thought were more advantageous to ourselves and our investors.
Yeah, well, I mean, at the end of the day, that would have limited your growth. I mean, holding on to that asset and not recycling that capital would have slowed your overall growth of the company. If you're a completely different mindset and you're just looking to, over the 30-year span, buy a couple properties that are going to offset your retirement income, and then that's a different bucket, completely different bucket than what we're talking about here today. And so,
and by the way, I think that's a great plan for some part of your assets.
Yeah, sure, absolutely.
I mean, we cut our teeth in the business backed by private equity, by hedge funds and private equity, and by nature that kind of forces you into a trader mentality, because those folks are completely IRR driven.
Yeah,
I ultimately had to come to the conclusion that IRR was good, and it's an interesting measuring tool. Most investors probably really don't understand it, but it's a good measuring tool. But I friend of mine gave me an expression years ago, and it's been repeated by dozens of people in different formats. But my CCIM teacher, many years ago said, IRR is good, but you can't go to the grocery store with it. You have to have whole dollars. So we became much more focused of late in whole dollar returns, equity multiple, other measuring. So IRR is still part of our formula, but it's IRR tied in with equity multiple. Is I can make 1,000% IRR if I do something for a very short amount of time, but I've got to match time in multiple with it. So if I can double my money in a day, that's great. But if I make 1,000 IRR in a few seconds, and if I've got a system I could do that all the time, that'd be great. If I were a trader and I could figure out how to scalp the market, or get a little piece of the market, a little markup all the time, that'd be great. But I don't have that system. My system is slow and methodical because real estate tends to move more slowly. It's more bureaucratic. There's a lot of transactional friction between taxes and title insurance and commissions. The trading cost is not small.
No, so I think that all sets a great foundation here. And you guys, I mean, you pride yourself on being value add and opportunistic investors. And so With that being said, and you've had your hand in a litany of asset classes, right? You guys, you go to where the opportunities lie. You just don't say, hey, we're multifamily guys. We're going to buy multifamily no matter what time of day it is, no matter what's happening in the market, what cycle we're in. You guys go to where the opportunities lie. And so talk to me about staying ahead of the trends, truly staying one step ahead of maybe the competitors and seeing the opportunity, not where it's necessarily at today, but where it's going to be in the fairly near future.
Kevin, I use an expression. Our business is about making the invisible visible. So we have to see into the future, and it's a long future sometimes. I'm in the midst of a project that I started. I first looked at this project in 2009. We acquired in 2010, and I'm still pretty deeply invested in the deal, and I'll be in the transaction for the rest of my life because I'll own some pieces forever. My kids will own them for their lives. And I had to go see what was there at the time, and what it was kind of a decrepit office building and a semiconductor chip plant, and I was like, well, what do we do here? And you had to have vision. We have to do that across the way, and I would assume that many of your listeners, if they're real estate focused, they've driven by something many times in their life, in their neighborhood or their region. And then all of a sudden something changes. A building goes up and they're like, wow, I wish I'd thought of that. Well, we're the people who wished we'd thought of it and then think of it and then do it. And that's our business. Is we don't want to be the person who drives it through the neighborhood and sees what somebody else does. We want to drive through the neighborhood and be that person. We want to be that group who says, we bought an oil storage facility and we're turning it into housing in a hotel. That takes vision.
Yeah,
there were 3 500 million gallon oil depots on our property. So
is that, I mean, but is that a born trait, or can that be learned? That strategic vision that we're talking about here.
No, I think it can be learned. I've been able to teach people in my organization, to what the secret is to seeing things. It's been hard. I will tell you, I've gone through a lot of acquisitions people to try to get a couple of people who can actually replicate what I do and the vision that I do and how I see it. But yeah, I think it can very much be learned. It's not an overnight thing, but it also doesn't take 40 years. I mean, the one thing I'm consistent in telling young people, whether they're investors or they want to do what I do, I mentor a number of young folks pretty regularly. And the number one thing I tell them is it doesn't take as long as it took me. I'm just hard-headed. And I had mentors, but I was slow on things. And I was fearful on things, and I had to overcome things. And so I had to put myself in a place where I was willing to work without a net. And my mentor, my number one mentor, came to me when I was running my real estate brokerage company many years ago. And he said, how much money are you making today? And I was making about, dependent, but this is 35 years ago. I was making, $350,000 to $500,000. It's pretty good money then. Pretty happy with it. And he said, how much money do you want to make? I said, well, I think I should be able to make $1 million a year. And he said, and after you make $1 million, what do you think you're going to want to make? I said, something more than that. And he said, well, I can tell you the mindset that makes 100,000, you have to forget what that makes you 100,000 to make 500,000. And if you're making 500,000, you have to forget some of the things that to make the million, or to make the whatever. I have an objective. I haven't achieved it yet. Is to have $100 million a year. I have not made $100 million in 1 year. I've gotten where I can see it. It will happen. And I don't say that to be braggadocious, but I've said what I had to do was completely forget the thing that made me $500,000 a year and made me comfortable at 500. I had to get uncomfortable to even imagine making $100 million in a year. Like maybe it never happens for me, but it's a pretty audacious objective. I would admit.
Yeah.
And I assume 99% of the people who hear me say that they won't even be able to hear it because it will be so outrageous and so uncomfortable for them. And actually, I used to teach this real estate mastery program, and I actually had an exercise where I put the number 1 up with a dollar sign, and then behind a piece of paper I had written a whole row of zeros. So you'd look at it and say, well, nobody's uncomfortable at $1. Move the paper over a little bit. It's $10. It's $100. It's $1,000. Even at 1,000, you start to lose a few people in the audience. You get to 10,000, you lose a few more. 100,000, you lose a lot of people at 100. 100 makes people. Then you go to 1,000,000. 1,000,000, you lose a lot of the room, and then you keep going. And I said, but it's all the same number. It's just 1. It's 1 and some zeros. So it's an exercise to retrain your mind and retrain your brain to not be afraid to have abundance. And that's what I had to do, was I had to retrain my brain to not be afraid of having abundance. And if I could figure out $1 million deal, I could figure out $1 billion deal. Because it wasn't anything any different, just bigger money.
A lot of the mechanics. I mean, there's obviously maybe some slight differences in mechanics of putting together that much larger of a deal, but generally speaking, there's more similarities than there are differences. It's just, again, bigger numbers, bigger deal. And so no, I love every bit of that.
And it's going to, maybe it's going to a bigger market. I could go buy apartments for $100,000 a unit, or I could go to a market where the rents are higher and the units are $700,000, or $1 million a unit apartments, which we have in our market. So I look at that and I'm like, if rents are relative and returns are relative, maybe I could just do less and do more. And so it's led me to a different line of thinking. And I've been fortunate. I'm fortunate that I have a group of largely like-minded people working here. Look, this started with 3 partners. I had 3 partners and 1 employee in 1992, and we started the company with $1,000 in the bank. We each wrote a check for $250. So it's not like it takes a lot of money. It just, I don't think you could do that today. Maybe you could, but inflation would change that number, but it would change it to a number that people could do. And I see people do it, by the way. So, I think it's just a willingness to let yourself succeed. And for some, I tell them, look, if you're not committed to being a full-time investor, learn how to invest well with others. That's what our job is.
Yeah.
And we tell people part of our job is we have anxiety so you as an investor can have slightly less, because investing causes anxiety.
Yeah.
And if investors pick sponsors, people that they trust to invest with, and we've been able to build that trust over 30 years, I have anxiety for them so they don't have to have as much. I've learned to manage my anxiety. I've learned to compartmentalize it, but I will tell you, every time I'm making an investment decision, I have anxiety.
Sure.
And when I have the closing, there's this moment of celebration, but then there is this overwhelming anxiety of, did we just do the right thing?
Yeah.
Did we sell for the right price? Did we buy for the right price? Do we have the right business plan? And I don't say it doesn't. The difference is my anxiety doesn't freeze me from action. It just gnaws on my brain to be thoughtful about the decisions I make.
That's, I think it keeps you in alignment, correct? More than anything else, it keeps you
Yeah.
in a straight alignment. No,
Yeah.
I love that, and I want to be mindful of your time as well. I know we've got we're coming up on the our spot here. We've got about 14 minutes left, and there's a couple other I'd like to shift gears real quick if we could, and get your perspective on a few other items here before we wrap it up, Bill. And one being, we talked about, there's still kind of lingering effects depending what market you're in. They're different than the next, but still we can all agree that there's lingering effects that we can both visibly see today, and there's some effects that we probably won't be able to see for years to come as a result of COVID, right? Different impacts that COVID has had on the different, different markets, but more specifically different sectors of real estate. And would love to get your perspective on the office, and we can talk about retail and a few other, maybe shifts in migration patterns and things of that nature and how COVID's impacted that. But I'd love to start with office. And I feel like that is it's such a big unknown at this point. And we're just wondering what the world looks like in 3 to 5 years as it relates to, going back to the traditional office space, 100%. Is it a hybrid model? What's that hybrid model look like? And then ultimately, if we're left with a large surplus of office space, vacant office space, what do we do at that point in time?
That's a
lot to digest there, but
yeah, we'll try to do it justice in a couple.
Yeah, tear it apart as you would like.
I think the jury's still out. I think I do think that people, for many businesses, people work better in the office than not in the office, and I am highly suspect of work from home being the solution, namely because I don't think that people work from home. And I'm not saying they don't work at all from home, but the idea that they're more efficient at home is probably a job by job issue.
Yes.
I have employees who I think do very good work at home, and so I'm not throwing the whole group out. But I also think there are people who can't work at all at home and they need structure.
Yes.
But the other thing is, I think that we do things that are synergistic in our business that require us to collaborate and be together. And so, my real estate team is in the office more days than they're not. But I think the world is like, rather than talking about my company, I'll talk about the world. I think the world is going to be hybrid. I think that the idea that all businesses will go back to work 100% of the time in an office, probably not likely. I think it's going to be too difficult to convince the employees of that. And I think that the world will, I think the employer will lose that battle. In a few cases, you'll be able to do it. In many cases, you're going to send all of your people, remote. I think some places are going to take more space to provide more social distancing, but also to provide a different and better work environment. So I think we've been densifying office space for years, and I think we're going to go back the other direction. I think, the decision we made, and I think it's a decision that many that I'm talking to are making. We went for better quality space because we think if you're going to ask people to come to the office, it can't be generic. And so we went to what I think is the best building in our marketplace. The environment is great. And if you're going to bring people back to the office, you better bring them something more than just 4 walls and windows. So it's taken us on the investment side. When COVID broke out, I said, I'm never going to buy another office building. And that's proven untrue because I've bought several. But I bought buildings where I thought there was an interesting play and that I liked the submarket dynamics and I could capitalize on those dynamics.
I'm going to stop. I'd love if you would speak to just pick any one of the ones that you bought here over the last 2 years and give us just a high level case study of what was the opportunity that you identified in that office after making the, kind of the comment at the beginning of COVID, I'll never buy another office again. Right. So help us understand those dynamics and how they played out.
We bought a 3-building complex that was leased to a, public company and on a long-term lease, like 11, 12 years on the lease. The market was still extremely dislocated at the end of 2020. And so we bought that, put a kind of an interesting capital structure together, we realized the play wasn't just that it was 3 buildings. The interesting play was it was 3 buildings leased to one tenant, but 3 separate leases. So we immediately looked at it and said, this is a big asset for this marketplace, but we could carve it up into 3 separate deals and sell it into the 1031 market to high net worth investors. It was too big for a high net worth investor, but it was right sized for individual investors. In fact, we've sold one of the buildings. We're under contract to sell the second one and possibly the third one to that same group. We also, at the time, bifurcated the ground, and we sold a ground lease, 3 separate ground leases concurrent. And so we basically created a 7 cap investment that we're selling at a 5 1/4 cap. And so we were able to create our own cap rate compression kind of instantaneously.
Yeah.
So, we bought a stabilized triple net lease deal, and we'll double our equity in 2 years. So that's why I bought an office building.
That's great.
I bought another one that we bought an old Nordstrom store in Santa Barbara, and we're converting it to creative office. And the reason we liked it was that the tech industry is on fire there. That is, as COVID kind of raged, they migrated out of Los Angeles and San Francisco to what was a more employee-friendly market. In Santa Barbara was a cool place to go, and office rents were very cheap relative to LA and San Francisco, but we were able to get very big rents relative to where they had been 2 years ago.
Mm-hmm.
And so, San Francisco, where rents are, $80 to $100, where rents in Santa Barbara might be $45. That's very attractive to the tech companies. They're hiring young students out of UC Santa Barbara's microcomputing program. And we're like, okay, we can capitalize on smart brains coming out of school, tech coming in to gobble up these people, and we can fill a space need for them. Mm-hmm. So it was understanding kind of what's going on in the technology world and where their employees were coming from, and going and figuring out how to fill that niche. And I think we did it very effectively. So it's again, but it's going to where the puck is in the hockey parlance. I don't play hockey, but it's, you got to skate to where it's going, not where it is.
Yeah.
And that's what we did. We said, man, we see this shifting very quickly. I don't think the rest of the world is seeing the shift. And we're going to be there, and we're going to invest in that. I think generic office, if I owned what I'd call commodity office, mm-hmm. I would be terrified today.
Okay. Now that's what I was going to ask you.
So commodity office,
where does that leave us with commodity office?
Commodity office is going to find another use. Mm-hmm. And I think if, we just sold an office building that fit that commodity office category, and we lost money. And I will tell you, I'm ecstatic to have the sale. I'm thrilled to lose money, because I'm thrilled to, so this is one of those, I could have held it forever, not lost money. But instead I gave the capital back to our investors, and redeploying 70 cents is better than me holding 70 cents on a wish and hope game. And it's not going to get better.
Well, I think it's speaking to that vision as well. Like, you see the future vision of, at least of that building. It's not going to get better, in your humble opinion. It's just not. And so, like, it's
my vision
slow death,
of that,
or let's cut off the infection right now and move on to the next.
My vision of that building for the day I bought it to today has changed, and it's changed markedly because of COVID changing the dynamic of the worker. And I think I look at generic office, and I go through some very fast math, and I say, I look at rents, I look at TI cost, which have skyrocketed, where it used to cost $20 to do tenant improvements. It's $50 to $75 a foot. Mm-hmm. And if you look at a typical rent, I'll just give you a quick example. In this submarket, rents are $30 a foot. Operating costs are $10. I'm just making numbers up. That leaves me $20, and it cost me $50 to TI it, and I get a 5-year lease. I'm making very little money in that 5 years. I got $100 of net income, and I've spent 50 of it on TIs. I've got $50 of income over the next 5 years. Mm-hmm. on that square footage. I divide it down, and it just doesn't leave much value left. And then I look at the refinance risk on these buildings, and I think that if I were an investor, I would not buy office just because it's cheap, because it's cheap for a reason. And I take people back to my Warren Buffett idea, which is, Warren Buffett and Charlie Munger started with what they called their cigar butt theory. Mm-hmm. They bought beat up old companies to take the last few puffs out of them because they bought them cheap. And they changed their philosophy to buying quality and paying fair value for quality. And I think buying cheap, and we buy cheap occasionally, but we buy cheap knowing we bought cheap, and we just got to sell it to somebody a little less cheap. I think the better strategy is buy quality, because quality has an enduring value.
Yes.
I know Ben's going to kill me if I don't get one thing on the record, which is, there's other alternatives in the investment spectrum. And, and like today, we realized a lot of our clients, one of the ways we could reduce anxiety for some of our clients was to provide a fixed income product. And we came out with a secured credit concept that we've offered to our clients. And, and it pays, 12%, in a quarterly payment on a couple-year program, where if you have anxiety and you've got some money, it's a great way for people to kind of deal with still getting some gain. And by the way, gain above inflation, and getting certainty of gain versus uncertainty that they've got from the market. And so I had to make sure.
We talked about it a good bit.
Ben was going to lecture me if I didn't get that in.
I let Ben give his plug earlier before you jumped on. So
that's why you were told 9:15, Bill.
Yeah, I know that, but his plug is over his shoulder, and please, if if that were to interest somebody, please reach out and talk to Ben about that. But I think, look, we've been blessed to have a long career in the investment world. I love being able to share my ideas. People are like, people tell me all the time, I can't believe you tell people so much about strategy. Don't you worry that, people are going to come compete with you? I said, the world is large.
Yeah.
And by the way, if they want to compete head to head with me, good luck, and by the way, we compete with our friends all the time. Mm-hmm. We can't win every deal, and we don't want to. Sometimes we stand aside. I will tell you, one of the things, we can do in this industry, insider trading is not illegal in real estate, unless you're in the public real estate market.
Sure.
But in the private markets, insider trading is not illegal. We're talking to our friends all the time. When something comes up for bid, we're talking to friends. We've got friends of ours who buy, but they also provide equity, and they'll call us and say, look, if your bid is above our bid, we're happy to put equity with you. And so we use our relationships to solve for creating value. Mm-hmm. And I've got 4+ decades of relationships. I think I have 8,500 contacts in my Outlook, and people are like, how can you possibly know 8,500 people? I said, I've been doing it a long time. Yeah. And every time I meet somebody, I take their card, I send them a thank you note. I literally send a thank you note and say, it was lovely to meet you, and it's all about building a relationship. Mm-hmm. So.
Yeah, well, no, all great. I know we're literally right at that time, and I didn't know if you had 5 extra minutes. If you've got a hard stop, we can jump off here. But
I actually do have pretty much a hard stop, because I'm trying to get a deal financed today.
No, I figured as much. So no, and it's been absolute delightful to have you back here, Bill. We'll have to make it not 6 years again the next time that we have you on the show. And there's a million other rabbit holes I think that I would love to have gone down. And so maybe I will court you here within the coming months, and maybe find another time in your schedule to get you back on and go down. Because there's so many things happening. We're such a dynamic place in time right now, and there's just a lot of moving parts to not just real estate, but just the economic cycle that we're in. And so would love to continue the dialogue there. And but anyway, I'll let you go. I know you've got to get off here, and so thank you so much.
Happy to join you in the next quarter.
Yes. Yeah, that'd be fantastic. So thank you again, Bill. Ben, pleasure having you as well, and appreciate both your guys' time.